We can start now.
Okay.
Welcome everyone to SEMLA's weekly research seminar. This week we have the pleasure of receiving Christopher Sims from Princeton University. Professor Sims was trained both in mathematics and economics at Harvard University and also studied at the University of California, Berkeley. His areas of research interest are on economic theory for dynamic models, macroeconomic theory, and policy. And as you know, he has many distinctions, among them being a past president of the American Economic Association, also of the Econometric Society, and in 2011 joined with Sargent. He was awarded the Nobel Prize in Economics for their empirical research on causes and effects in the macroeconomy. He is currently the John F. Sherritt University Professor of Economics at Princeton University, and he also has a associate status in the Department of Operations Research and Financial Engineering. He previously taught at Yale University and the University of Minnesota, and I'm sure you are very familiar with his work. He has made very important contributions both to theory, methodology, and also he has developed a lot of tools that many of us use on a regular basis when we are either solving general equilibrium models as his algorithm to solve these type of problems, or when we analyze econometrics with vector autoregressions or some other techniques that he had developed. So without further ado, let me allow him to start his talk. Thank you very much.
Okay, thank you, Alberto. This is a talk about rational inattention and monetary economics. Most of it is about rational inattention. I talk along the way. I discuss applications to monetary economics. It's based on the article, the chapter of the Handbook of Monetary Economics with this same title, though this talk includes discussion of some more recent research by myself and others in this area. So let's begin. There are a few slides. You shouldn't be disturbed if you see only a title when a slide comes up. There are a few slides like this that are just meant to remind me of things I want to say without any bullet points. So first is motivation. Why are we studying rational inattention, and what is it? We know that information that's freely available to us sometimes goes unused. We may scan the business pages of a newspaper every morning out of habit, and if we were true rational agents with unlimited capacity to process information and do computations, every line of the stock market tables, every point on the term structure of interest rates that's reported that morning should in principle have some effect on our consumption decisions and our portfolio allocations. We should be reacting to all of that. In fact, hardly anybody reacts on a daily basis to that kind of information except people who are professionally involved in financial markets. So the question is, how should we bring this fact into our modeling of economic behavior? How should we modify the standard model, which has everyone using all available information in the optimal way at every instant? How should we modify that model, and what effects does taking account of imperfect processing of information have on our conclusions about economic issues? If we look at macroeconomic data, we see that when we do impulse responses with reduced norm vector autoregression, the standard result is that down the diagonal of the impulse response array, where we show responsive variables to surprise changes in themselves, we get immediate responses that are persistent, but there's a jump upward at 0 and then a slow evolution after that. Whereas off diagonal, where we're showing responses of variables of one variable to another, we see either very little response or responses that are hump-shaped. They begin small and grow over time. It's very difficult to explain this with this pattern with the standard theoretical devices to introduce inertia and stickiness into behavior. And we'll discuss that a little bit more in a minute. We also see, when we look at individual behavior, discreteness. That is, we see when we look at the prices posted in grocery stores or other retail establishments, the prices stay stable for long periods of time and then they jump. And furthermore, they don't typically jump from one price to another totally unpredictable price. They often jump back and forth between a set of 2, 3, or 4 pricing points that repeat over time. This is a pattern like this has been documented in a paper by Eichenbaum and Ravello and Jaimovich, looking at grocery store prices. This again is very difficult to explain with the usual devices of costs of adjustment. Costly adjustment should imply long periods of stable prices, but once the prices change, it's very difficult to explain why it should go back to exactly the same price again if the problem is a menu cost or a cost of adjustment. So we want to account for these observations, and one way to do it is to formally model agents as paying a cost to process information. Shannon defined mutual information between 2 random variables or random vectors by the formula that is written on this slide. It may look mysterious where this would come from, but it turns out that this is, once you've imposed a couple of axiomatic restrictions on mutual information, this is really the only, up to adjustments by constants or scalars, this is really the only measure of information that's useful. And this is reflected in the wide usage of this measure in engineering problems. In fact, we're all very much aware of the use of this kind of measure of mutual information in daily life now. We are used to evaluating the speed of an internet connection in bits per second, and bits per second is exactly the bits unit is exactly Shannon's measure of information content. And this is useful to us, this measure of speed of a connection is useful to us because it tells us how fast we can send things over an internet connection without having to specify whether it's text or pictures or music or an assembly language computer program. All of these things, the speed on all of transmission on all of them is measured by this bits per second measure. I won't try to go into the axiomatic foundations. Intuitively, the basic idea is once you say that your measure of mutual information is going to depend on the probability distributions, that means it depends on the probability distribution and not on the values of the random variables. So the information in being told the answer to whether x is 1 or 2 is the same as the information in being told whether x is minus 1 million or plus 2 billion, so long as the probabilities of the 2 possible answers are the same. So you need that the information measure depends on the probability, on the joint probability distributions of the two random variables, and also that the information measure is additive in a certain sense. That is, we'd like our information measure to be one where we can break up the information in a vector of random variables and say, well, let's look at how much information we get about y when we see x1. And now, given what our conditional distribution of y is given x1, we'd like to know how much extra information we get when we add observation on x2, and so on until we get to xn. When we add all those up, what we'd like is that the answer is the same as the information in the whole x vector about y. And that condition, together with saying that the information depends only on the joint distribution, is basically all you need to come up with the notion that no information measure other than Shannon's works. So I'll skip the slide which says just what I just said. Now, there is a tradition in decision theory of measuring the value of information in a different way. And the Shannon information measure is not an alternative. It's just a measure. It's a very different kind of information. Much of the existing decision theory literature will answer the question of, suppose you don't know how much oil is in a field you contemplate buying. You can ask, what would be the value to you of seeing the results of an exploratory well? Now, the exploratory well may be very expensive to build. The value to you of this information may be very large. And so this gives you a dollar measure of the value of information. The cost of drilling the well is the dollar measure of the cost of obtaining the information. But none of this has anything to do with Shannon. It may be here in this example that the exploratory well will either be dry or show there's a well. So there's and you may have uncertainty that's 50% probability on there being oil and 50% on there not being oil. Then the Shannon information you're getting is 1 bit. 1 bit is the amount of information you get in resolving the uncertainty over a simple 2-point distribution with 50% probability on each answer. And this measure, this Shannon measure of how much of the amount of information you're getting has nothing to do with the decision theoretic measure. It's important to keep these points, these differences distinct. Otherwise, one can get confused about what the Shannon information theory is actually doing. The Shannon information theory is a theory about applying it to individuals, is a theory about why individuals don't make use of all the information that's available to them at no physical cost. The cost is all mental processing. So the amount of information that's being processed doesn't have to do with its value to you or how much it costs you physically to obtain it. The cost of processing the information is the psychological cost of transforming the information into action.
Chris, may I ask a question?
Yeah. Go ahead.
So talking about information processing cost as modeling data at individual level, is this theory going to be able to replicate pricing moments at the micro level, meaning small and big price changes, meaning the frequency in which regular prices change versus the sale prices that you were mentioning before?
Yes, well, I wasn't mentioning just sale prices. One of the things you see, though Eichenbaum, Jaimovich, and Rebello don't emphasize it. If you look at their plots, you're not seeing just regular prices and sale prices. You're seeing often 3 or 4 point distributions that go back and forth. And they're not necessarily sales. They're just that prices, when they go up, tend to go up from 67 cents to 77 cents, and then they come back.
But still, they do move through time, probably in low frequency, but still there could be some patterns that they follow. So I wonder whether the rational attention theory is targeting on matching this type of behavior of these, let's say, reference prices or
Yes,
menu of prices.
yes. If you look at, there's a paper by Philip Matejka, Matejka, that looks at a model of monopoly price setter subject whose costs are fluctuating and who has an information cost of reacting to the fluctuating costs. And he shows that even a simple static version of that problem produces time series of prices that look very much like the time series of prices that Eichenbaum, Janovich, and Rebello report. So it does target.
Okay, and about the distribution of small and big price changes that people in menu cost models are making big deals right now?
I haven't really thought about that, but it'd be interesting to ask whether you can get that. And one of the interesting things about the information theory-based approach is that the distribution of decisions changes as a function of the distribution of initial uncertainty, and as a function of the cost of errors. So to look at large and small price changes, you'd want to ask, well, what is the distribution of the underlying cost variable that's pushing the price changes, and what's the distribution of the loss function? You can get quite different distributions of actual decisions depending on how those vary. So for Gaussian random variables, where the joint distribution is normal, mutual information, if there's just a bivariate distribution, mutual information is a monotonic function of the R squared. Mutual information goes to infinity as the R squared goes to 1, and goes to 0 as the R squared goes to 0. That's expressed in this formula. So one can take the standard linear quadratic optimization problem that's often used as a first order approximation in macro modeling, set up a quadratic objective function, set up a linear state space evolution equation, and then add the last two lines on this slide, which say, well, as I've written it, it's not a cost of information, it's a maximum capacity, kappa. And then it's important to recognize that when you set up this problem, one can't slacken the information constraint by forgetting some stuff you already knew at the start. So that's that last line that says that it basically says that the initial uncertainty at date t, which is the first two terms in that last line, has to exceed that covariance matrix must exceed the covariance matrix that you end up with after you made your information processing at time t. That's important because that constraint is kind of a mess to implement. If that constraint were not there, it would be possible to get an analytic solution to this problem quite easily. But with this constraint, in practice, it often turns out to be computationally demanding because one has to experiment with all possible eigenvectors of the matrix on the last line that could correspond to 0 eigenvalues. It can be shown that with quadratic loss, it's optimal for agents would like to make their ex post uncertainty also normal. with quadratic, it says with and if the exogenous random signals are themselves normal, then the whole model remains normal period after period. When we solve these quadratic problems, for example, in my first article on this topic, Implications of Rational Inattention in the Journal of Monetary Economics, I solved the permanent income, the linear quadratic permanent income model with an information constraint. And you see that the exogenous random signals, in this case the time series of fluctuating incomes, responses are smoothed and delayed relative to what you get with no information constraint. And furthermore, there is information processing randomness in the choice variables. That is, if you look at the permanent income problem, you see, and you assume that individuals are responding to a given exogenous fluctuating time series of income. Their behavior will contain randomness that's independent of the randomness in the income processing itself. And that randomness will be less serially correlated, less persistent than the component of their choices about consumption that does respond to the systematic part of income. And furthermore, what comes out of solving these problems is that imperfect information processing tends to produce solutions that are only slightly worse than what you would get with fully accurate information processing. This is important because it implies that a realistic analysis of how much information processing people are doing implies that they're using very little of their information processing capacity, monitoring these economic variables and reacting to them. And that's plausible because the benefits of reacting more precisely are very small. In these linear quadratic problems, every rational inattention solution corresponds to a rational expectation solution in which the state variable is observed with noise. But the two problems are not equivalent. The rational inattention solutions are a restricted subclass because they imply a relation of the noise distribution to the distribution of the exogenous randomness. Another way to put it is that a rationally inattentive agent is choosing the form of the noise in his observation of the state, so that the nature of the uncertainty he faces and his loss function will determine the nature of the noise in his observation of the state. So it's the rational inattention solutions are a restricted subclass of rational expectation with noisy observation solutions. Now, you'll notice that in describing this problem, I said the individual is maximizing over a choice of the control variable C and the covariance matrix sigma. So the question is, what does it mean to think of the agent as choosing a joint distribution for his actions and the uncertainty? In a linear quadratic case, Gaussian case, this is easy to understand since choosing the joint distribution is equivalent to choosing the covariance matrix of the error in a noisy observation of the state. We can always make this kind of interpretation of a rational inattention problem. But outside the Gaussian case, the observation error that the agent chooses is not simple additive noise. It'll have a distribution that varies as a function of the state. And furthermore, this slide doesn't really give the answer to why does it make sense in a general case to think of the agent as choosing a joint distribution for his decision and the exogenous uncertainty about and the state. Why does that make sense? Why is it, since we usually think of the individual as actually choosing his decision variable each period rather than choosing a joint distribution? But you can break up the problem into two steps. One is you decide what kind of noise there's going to be in your observation of the state, and then you decide, given your noisy observation of the state, what function of that noisy observation should your decision be? And the two steps together imply a joint distribution for your action and the state. And it turns out that while there's not a unique solution for the nature of the observation error you'll choose, there is a unique solution for the nature of the joint distribution of your action and the state. I just want to mention, this is another of these blank slides, there's another formulation that's related in its motivation. It was originally proposed by Mankiw and Rice, and it's called sticky information. It's actually appeared more often in estimated macro models because it's easier to implement by quite a bit. What Mankiw and Rice do is say, suppose that that people observe the true state only infrequently, that it's costly to observe the state with higher frequency. So the agent chooses the frequency with which he observes the state. Once he observes it, he reacts to it optimally. This has some plausibility. It's not at all equivalent, and it has different implications for time series behavior and for behavior at the individual level. I think it's not as realistic. In particular, it's not realistic because it implies that all information is used optimally at the dates where decisions are made, when in fact I think it's easy to verify that that's not true. Also, the rational inattention approach implies that agents are constantly monitoring the information. It's just that they often don't actually do anything about it. And when they do something about it, it doesn't really imply that it's a different kind of date than other dates. It's a smoother model of behavior. Now we can go beyond linear quadratic problems. The first one of these that appeared in the literature is in a couple of papers by me. It's a two-period saving problem. No, it left the integral sign out of the first line here. You're choosing a joint density function, f of C and W, where C is first period consumption and W is your wealth. Your utility function depends on your consumption and your wealth, because in the second period you're going to get to eat W minus C. And it's required, of course, that initial consumption is less than or equal to W, even though the framework here is that you don't know W, you don't know your wealth, and you are choosing C subject to imperfect knowledge of W. So conditional on your choice of C, you'll have a distribution for W that's not concentrated on a point, but does have the property that the W minus C is positive with probability 1. This kind of constraint can be imposed without requiring infinite mutual information. In some special cases that I worked out in the papers that are cited, there are continuous joint distributions for C and W, but numerical solutions generally produce clear discrete components of behavior. That, in fact, they generally produce completely discrete distributions of C, even in situations where C would be continuously distributed if there weren't an information cost. And in results that I and some co-authors now have in a paper that's still under revision, we see that these computational results are not an accident. Whenever the distribution of W in this problem has bounded support, as it always must in any computer implementation or discretized computer implementation, the solution must necessarily concentrate on a finite number of points. In other words, the way individuals. So and in results that I'll describe in a minute, we show that it's really just about generic, that you find that the distribution, well, I started to say here, you're uncertain about W. If you're uncertain about W and you have costs to collecting information about W, you have some initial distribution for W, say that it's a gamma distributed random variable. Then you ask, with my log utility loss function, what should my joint distribution of C and W be? And it turns out that in the case of log utility and gamma distributed W, you get a continuous joint distribution for C and W. But as soon as you say instead of gamma, it's gamma truncated at 5 standard errors, the solution is necessarily concentrated on a finite set of values of C. And with relatively high information costs, you find just 2 or 3 or 4 points in the space of possible values of C. So this is suggesting that observing sluggishness in people's reaction to information, even about their own wealth or income, should not be a surprise if people have cost to processing information. This is the information capacity constrained monopolist problem that I mentioned earlier. Mateka has a seller-facing IID random variation in cost and a fixed demand curve, and he will then choose to make the marginal distribution of prices discrete, and he shows that the time series of prices produced match many things, many aspects, not just the fact that the distribution is discrete, but also the nature of skewness in the distribution that is found in Eichenbaum, Jaimovich, and Ravello. Mateka also found in a more subtle paper that if you take a monopolist who is not constrained by information costs, but who is dealing with consumers who do face information costs, the seller, recognizing that consumers will have just a finite joint distribution, a finitely supported joint distribution of purchases, the seller will choose optimally to make the distribution of prices discrete, even though the distribution of cost changes is continuous. So now I'm going to talk about a more general static framework that covers these two pricing problems Mateka discussed, but also covers portfolio selection. It covers monopolistic pricing when the monopolist has multiple products with cross elasticities of demand, and other general problems where X and Y, X being the decision variable and Y being the state, are now multidimensional. They don't have to have the same dimension anymore. And we just say there's some objective function that depends on both the decision X and the state Y. And there's the individual has to choose the density function F and the measure mu X on decisions. That is, so discretely distributed choice will make mu X contain some lumps of probability in on individual points. So this says that there's an expected utility But there's a cost, and a cost lambda to the mutual information between the choices X and the state Y. And the side constraint is the joint density has to integrate out to the given initial marginal distribution on Y. That is, we start out saying before processing any information, this individual has a joint density over the state Y, G of Y. And then what turns out to be the nasty part of the problem, f of xy, of course, has to be non-negative everywhere because it's a density function. This is a problem that can be shown to be, if u is concave, this is a problem with concave objective function. Actually, it doesn't even depend directly on that because it's concave in the decision variable f, and variables f and mu in any case. And the information constraint is convex, so it's a problem where we know that solutions to the first order conditions are solutions. And it should be very well behaved. The problem is the f of xy greater than or equal to 0 constraints. When x and y are, in principle, could take on values anywhere in Rk or Rn, there are infinitely many of these f of xy greater than or equal to 0 constraints, each of which may require its own Lagrange multiplier. And that makes solving these problems nowhere near as straightforward as you might think if you forgot about that last line. However, there is an algorithm developed by engineers for this problem. This problem is what engineers call the static rate distortion problem. It's a general form of it. In the engineering literature, u is almost always u of some measure of the distance between x and y. Most of that literature, almost all of the literature that gets analytic results, I think all the literature that gets analytic results in engineering has x and y one-dimensional. So the u is just a weighting function for errors. And most of it has u quadratic. Most of that literature has u quadratic. There are some that look at absolute value measures and other measures of discrepancy in rate distortion. The paper that I have with Jung-Ho Kim, and Philip Matejka develops results for this problem for arbitrary analytic functions u and covers higher dimensional cases, which are not covered in the engineering literature. And this is important for some economic examples, as we'll see in a little bit. So what we can show analytically is that in cases where y is distributed continuously and the problem with costless information, in other words with lambda equals 0, produces a continuously distributed x as a solution, a solution with discretely distributed x is nonetheless very likely to emerge because of the information processing constraints. And we apply these results to several economic models in the paper. One of them is a monopolist selling two products with non-zero cross-elasticities of demand. We can show she chooses discretely distributed prices. An investor facing both intrinsic uncertainty in returns, which cannot be reduced by processing free information, plus an independent source of uncertainty that can be reduced by information processing. We ask, suppose an investor has a fixed stock of wealth, we suppose no uncertainty about that, and has to choose how to allocate the wealth across investments that with uncertain returns of this form. In other words, uncertainty in returns it includes some intrinsic uncertainty and some uncertainty that's just because you haven't done the research yet, or you haven't used all the freely available research. Such an investor, it turns out, will shift among a discrete finite set of possible portfolios. And this we actually analyzed specifically quadratic utility of final wealth, but the result about discreteness goes through for much more general utility functions. And this, of course, matches up with what people find when they look at behavior of individual investors. Most individual investors who are not professionals change their portfolios only at widely spaced intervals. And we also see investors adjusting their portfolios, for example, between going in heavily into cash and risk-free investments, or then shifting out and going into risky investments. And we show that that with natural choices for the joint distribution of returns and for the utility function, our agents who are jumping between discrete portfolios may have exactly this kind of behavior, where they jump back and forth between a portfolio that has that is heavy on risky assets and a portfolio that's short on risky assets. This is on this slide. I've really said most of it in the introduction. Prices and quantities both behave in an apparently inertial way. When you look at existing macro DSGEs, they have adjustment costs all over the place and Calvo pricing. These costs are there to prevent what happens in a model of rational expectations agents, fully rational agents, which is that without such adjustment costs, every policy change has very large initial effects. The public should react instantly to a change in the policy set, interest rate, and monetary policy. And instead, we find that in fact, interest rate changes, optimal forecasts of future interest rates change along with that. This should, if agents were fully rational and it did not have adjustment costs, this should result in immediate adjustments in portfolios, in consumption plans, and investment. We don't see that. Information costs offer a more unified explanation for the same pattern of behavior, and they have different implications for policy. If, for example, in asking about what the costs of business cycles are, Lucas has a famous computation based on the idea that people have diminishing returns utility functions. The DSGEs we estimate now have costs of adjustment of consumption, habit elements that imply that people lose a lot of utility if they are forced to change their level of consumption quickly. Now, another way to explain why they don't change their levels of consumption quickly is to say that most of the time they are not paying attention to the signals that our rational expectations models imply should make them change their consumption levels. Their consumption is sluggish because they're not reacting to information, not because there's a big utility cost of adjusting the level of consumption. And as I said, the information costs that people pay tend in a realistic calibration to come out to be quite small. So the suggestion is maybe business cycles are not as expensive or costly to individuals as you would guess if you thought that the only way to explain smooth time paths of consumption was to say that there are costs to rapid changes in consumption.
Chris?
Yes?
This is Ernesto Paston from the Bank of Chile.
Yes?
I want to ask you a question about all this. It's related to what we were talking before about using microdata to discipline frictions for macro models.
Yes.
And so something that I understand that this question is not applies to many different types of literature, but maybe something we would like to see is that the way to discipline a rational expectation, a rational attention model to the microdata, and then look at the aggregate implications of that regarding business cycle costs, inertia, and other stuff. And the reason why I'm asking this is because we don't know from your presentation how sensitive are going to be the macro implications of the rational attention model with variations in this information processing capacity.
Yeah.
Which is something I'm not sure how we can pin down from microdata, maybe from the work with Philip Mateca, but this is something we don't see in the presentation so far.
My view is that the notion that we start with microdata and go to macro once we pin things down is naive. As we go to microdata, more and more complications emerge. When you think about pricing in a grocery store, I think that information processing does play an important role, but it's not the only reason why we see the patterns of price behavior we see. It's quite clear that besides the jumping between discrete points on top of that, there's another tendency for prices to concentrate on $1.99, $2.99, $3.99, that is on psychologically prominent values, and you can't explain that with rational inattention. On top of that, we know that there is price discrimination across agents according to how much attention they're paying. So all grocery stores in the US price milk as a loss leader. That's because almost everybody who goes into the store buys milk and remembers the price. So it's sold below cost almost everywhere. That's not rational inattention. That's complicated interaction of rational inattention with various other industrial organization considerations. So what I'm emphasizing in this talk is qualitative implications. It's quite clear that people do have limited information processing capacity, and it's clear that you can explain some of what we observe by supposing that they do pay a cost to processing information. And at this point, it's very difficult to convert this into quantitative, precise macro models. And it may be a long time, maybe infinitely long, before we can really do that. Nonetheless, I think there are implications of this for the way we interpret our existing models, which have adjustment costs that are no more grounded in and have no more prospect of being grounded in microdata than do rational inattention approaches. I'll talk a little bit more about the difficulties with bringing rational inattention to general equilibrium problems as we go on. These are just a few of the other papers that exist in the literature that have looked at portfolio choice, macro price setting. Mashkowiak and Wiederholt have several papers, besides this one I cite, doing dynamic stochastic general equilibrium, where some agents have information processing costs. Tutino has done a fully dynamic, nonlinear quadratic optimization problem. It ends up being very abstract, only a few states, because it's so complicated to solve. The portfolio choice papers I cite here, unlike the analysis of portfolio choice in JKMS, which is this paper I have that's currently under revision, they all restrict, for analytic convenience, the form of the agent's posterior distributions conditional on information. And one of the main insights of the rational inattention approach to portfolio choice is that individuals, even if faced with a set of mutually independent observations with mutually independent noise, they will choose to aggregate these, they will choose their ex post uncertainty in such a way that in general there's correlation across the original uncertainty about this, across the states in their ex post distribution. This is one of the most important insights from rational inattention literature, and it's lost in these earlier rational inattention papers on portfolio choice. I'm now listing some of the things that are analytic challenges in this area. One is handling the, in linear quadratic problems, getting an efficient algorithm to handle the constraint that, what you might call the no forgetting constraint. There are some people who have been working on this since I wrote the Handbook of Monetary Economics paper. A more important and fundamental problem is general equilibrium. Mashkowiak and Wiederhold have a general equilibrium, a couple of general equilibrium papers with rational inattention, but they have agents of either one type of agent or in one of their papers, two types of agents who have rational inattention constraints. That is, they have information processing constraints. But in each case, they have the agents who have information processing costs dealing with agents on the other side of the market who have no information processing costs. This is important because it lets prices clear markets. But in a general approach to rational inattention to general equilibrium with rational inattention, prices do not clear markets in the way we assume they do in general equilibrium, because nobody participating in the market, on either side of the market, is actually fully aware of prices instantly. So it's not possible for prices to produce market equilibrium arbitrarily quickly by moving around, because agents don't realize that they've moved. Another way to describe this same issue is that if you put agents on both sides of the market with information processing constraints, you're going to need to introduce some mechanism that's not the Walrasian auctioneer to make demand and supply match. You're going to need inventories or specialist market makers or other mechanisms like this that allow the market to clear without agents being fully aware of prices. And this is going to mean models are much more complicated than our current standard macro models. Another area is that's very fundamental, in which there's really no work at all, is that we realize, and we've been more aware of this since the global financial crisis, money is useful for information-based reasons. Its value can be quickly verified. When I go to a store to buy a sandwich, I can't write an IOU and hand it to the cashier and say, take this as paying for my sandwich, but I can give the cashier money. And the cashier will not ask where I got it, or whether I'm in bankruptcy, or need to know anything else about me. In the crisis in the US, it's been argued that a considerable part of what went wrong in the financial markets was that intermediaries had come to rely on mortgage-backed securities, particularly the tranched CDOs, as practically equivalent to Treasury bills. They paid almost no premium. Their rates on them were very closely tracked those on Treasury bills. Because people thought of them as interchangeable, essentially risk-free, even though there were mortgages underneath somewhere, they were so insulated, the top tranches were so insulated from the risk in the mortgage portfolio that people thought they didn't need to do complicated due diligence in deciding whether to buy them or not, or what haircut to give them. So they became a kind of liquid asset, a kind of money. And then when it began to be seem possible that they were not all equivalent, that there could be bad high tranche CDOs, they suddenly became much less valuable, much less useful, and there was a big movement to turn them in for truly liquid securities like Treasury bills. So we have an informal idea that information is very important in money and in liquidity generally, but we don't have good formal models on this, and that I think good formal models will have to recognize information processing constraints. There is some work on why standard debt contracts might emerge in an environment of endogenous information choice. Stephen Morris here at Princeton and Ming Yang, who was a PhD student here at Princeton, have papers on these issues. In the area where, in the problems they work on, the Shannon measure of information is not the only one which gives the kind of results they are interested in. The important thing for them is that Shannon information implies agents are making choices about the nature of their ex post uncertainty, and that's the essential thing to get their results. Another big omission in the theory so far, as it's been applied in economics, is that it ignores what information theorists call coding. The reason Shannon capacity is such a good measure is that it doesn't depend on what you're trying to send through the channel. It's useful for rational inattention in economics because it implies we don't really need to know exactly how a person's brain translates a change in a price into an action, a purchase. All we have to know is the stochastic process for the price and the stochastic process for the purchases and the loss function. And that's the reason one can do that is Shannon's coding theorem, which says that if you give me any physical channel, that is a method for mapping inputs into a distribution of outputs, once I know the characteristics of the channel in that form, I can describe the maximum rate at which information can flow through that channel. But the reason that that this rate of information transformation doesn't depend on the nature of what's being sent is this coding theorem that says I can take anything, text, music, stock market tables, and translate them into the language of my transmission channel. So if it's a telegraph key, it would be bits and das. If it's a computer, it's zeros and ones. If it's a telephone line, it will be analog. It will be sine waves of various frequencies. It doesn't matter exactly what the form of the input into the channel is. Once we know the capacity and what it is we want to send, we can figure out how fast we want to send it. But this depends on the theorem that says there's a way to translate what we want to send into the type of input the channel can deal with. And that result, Shannon's coding theorem, says there's always a way to do it, but doing it may involve introducing delay, and delay can matter in decision problems. None of the literature in economics so far brings in coding delay, and it's not likely to for a while, because to discuss coding delay, we start having to get into neuroeconomics, into discussing exactly what is it that goes into the human being and gets translated into the human being's action. It'll be some kind of neurological signals, and coding delay will depend on the degree of mismatch between those signals and what we want to between those inputs and the economic signals we want to get translate into behavior. The theory also only tells us, when we apply it to an individual, that there will be randomness introduced in behavior by information processing. It doesn't say that what the nature of that randomness is. In particular, if you have a lot of people processing information, it's possible the randomness is idiosyncratic to the individual, and it's also possible that they're all making the same kinds of mistakes. It could be, this depends on whether they are individually solving their information processing problems or economizing on information by relying on newspapers, TV, imitating other people who seem to be well informed, or other strategies that economize in information processing by relying on common sources of information or reacting to the behavior of other people. The information theory, the rational inattention theory of individual behavior doesn't have much to say about these things, and yet they're very important for the aggregate implications of the theory. So if we can't actually produce a complete rational inattention DSGE, should we just be relying on our existing DSGEs with informational frictions, of course nowadays also with financial frictions? My view is that the implication of rational inattention, which is that there are lots of reasons people's behavior might be sluggish, that are not likely to be well modeled by adjustment costs. That suggests that it would be better not to rely on rational expectations constraints to restrict the short-run dynamics of the models we're using. One way to do that is the Del Negro-Schorfheide approach, which uses a DSGE to generate a prior for a structural vector autoregression. Part of the appeal of that approach is that you can leave out a lot of the inertia in the DSGE and use mainly the DSGE's long-run properties to discipline the structural vector autoregression. And that's a way of expressing lack of confidence in the rational expectation DSGE's implications for short-run dynamics. But more generally, when we're interpreting the results from a DSGE, I think it's very dangerous to try to compute optimal policy based on the existing DSGEs that are full of these adjustment costs by using the utility function of the agents in the DSGE. Because the adjustment costs and the utility costs of adjustment that are embedded in these models may be just proxying for information processing costs that would have quite different implications for optimal policy. This slide is another one of these blanks. It's Lucas critique squared. This is another implication for how we use existing models. Rational inattention implies that if we change the joint distribution of the shocks in the state to the underlying state, that behavior of individuals will change. Now, of course, the Lucas critique already does this in a way. It says if you change policy, the whole model will change because people's expectation formation rules will change. But the standard rational expectations approach to policy evaluation suggests that if only you estimate decision rules rather than naive regression models of behavior, then using the decision rules, you can correctly predict the behavior of agents as the policy rules change. But if the source of inertia in your model of individual behavior is not adjustment cost, but rational inattention, this can produce quite wrong results. The discreteness results that emerge from rational inattention imply that, for example, if the price level is stable enough, people may pay almost no attention to inflation. They may be extremely inertial in their reaction to changes in the inflation rate because there is so little uncertainty about the inflation rate. If you model this with a standard rational expectations framework, you might conclude that adjustment costs are very high and get the wrong answer then to what would happen if policy changed so as to make inflation much more variable, because the adjustment costs would appear to shrink because rational inattention would make people's reaction to inflation. So we've points. You should not evaluate the welfare costs of inflation with the EMA models. The frequency of product price changes in micro data um, to do nothing much to do with the sluggishness changes to macro stickiness. Sure that naively looks at how prices change at the micro level and thinks of price changes as interpreting it from Rice kind of perspective. Reaction the information that's measured by the gap between changes. But in a rational expectations framework, the agents are never reacting fully to information. So fairly frequently, and yet at the same acting in a much more sluggish every time they
Examples that
and then the last point
uh,
policy
so that
uh, people have much analytic uh, rational attention
we
theory tells
we
us
really
that
thank you for
uh,
uh,
in monetary
sharing
policy
presentation.